the confirmation of approved banks, and the global financial framework for years, countless individuals and groups across the world have carefully followed every update related to the potential revaluation and redemption of the Iraqi Dinar IQD and the Vietnamese Dong VND. What was once treated by many as speculation, rumor, or mere theory has gradually taken on a more structured and documented form. In 2025, the conversation has shifted significantly. The critical turning point arrived with the formal identification of the banks, credit unions, and financial institutions that have officially been cleared to conduct redemptions. This change marks more than just a bureaucratic update. It represents a long-awaited shift from hypothetical projections into the realm of concrete implementation. The announcement of approved banks provides participants with a sense of clarity. For years, discussions about the process were clouded by uncertainty. People debated which banks might be involved, whether redemption centers even existed, and whether there was genuine international oversight. Now, with an official list available and verified documentation behind it, the speculation gives way to tangible reality. The financial community, along with individual holders of IQD and VND, can finally point to institutions that are contractually bound to participate in this framework. This section explores in detail the significance of the bank confirmation, the global system that has made this step possible, the history of tier-based participation, the evolution of the safe banking network, and the intricate compliance measures that institutions have been required to meet. By doing so, we gain a clearer understanding of why this development matters and how it fits into the broader transformation of the world's monetary infrastructure. 1.1. The importance of bank confirmation. The inclusion of well-known financial entities such as Wells Fargo, J.P. Morgan Chase, Bank of America, HSBC, and TD Bank is not accidental. These are banks with deep infrastructure, advanced compliance departments, and proven international reach. By approving them, regulators and supervisors ensure that the redemption process can be carried out with both efficiency and security. Regional players such as Navy Federal Credit Union and Zions Bank are also crucial. Their involvement guarantees access at the local level, reducing the logistical challenge for retail participants, Tier 4B, who need to travel shorter distances to redemption centers. The blend of global giants and regional institutions reveals a design that aims for both scale and accessibility. Equally important is the messaging behind the confirmation. Participants now understand that this is not an optional activity for the banks. The commitments are binding. Institutions have been vetted, assigned responsibilities, and given regulatory mandates that they cannot simply step away from. This is no longer about banks choosing to participate out of potential profit. Rather, it is about compliance with a framework that has been put in place at the highest international levels. 1.2. The safe banking network. The mechanism through which banks were selected and verified is known as the safe banking network. This network functions as a documentation and certification system, ensuring that each institution meets strict operational and compliance standards. It is built to prevent fraud, mitigate systemic risk, and guarantee that only reliable banks participate in the redemption process. The Safe Banking Network does more than confirm identities. It also connects banks to a broader digital architecture that is being rolled out as part of a global financial restructuring. By requiring secure data integration, biometric authentication systems, and strict adherence to reporting obligations, the Safe Banking Network effectively locks banks into a uniform global compliance regime. Institutions that attempted to bypass or delay compliance simply found themselves excluded. This exclusivity reassures participants that only the most secure and prepared banks are involved, eliminating the uncertainty and risk of walking into unverified branches or dealing with unauthorized intermediaries. 1.3. Moving away from the old fiat system, behind the decision to approve and integrate banks into the redemption framework lies a much larger movement in international finance. The legacy system of fiat currency, money created by governments without direct asset backing, has been under pressure for decades. Debt levels ballooned, central banks engaged in repeated rounds of money printing, and systemic vulnerabilities grew apparent. The new financial model being tested and now implemented emphasizes asset-backed instruments. Instead of relying solely on debt issuance or speculative monetary policy, the framework ties value more directly to tangible assets. These assets may include natural resources, commodities, and other reserves. By connecting currencies and redemption systems to real-world assets, stability is enhanced and inflationary risk is reduced. Testing for this system has been underway for years, often behind closed doors. Early participants, primarily in Tier 3, operated under strict non-disclosure agreements. These trial runs allowed international organizations such as the International Monetary Fund, IMF, and the Bank for International Settlements, BIS, to refine procedures, lock exchange structures into place, and verify that redemption centers could process transactions securely. The most important outcome of these trials is that exchange rates for certain currencies were not only drafted, but locked into binding structures. This means the framework cannot easily be reversed without dismantling the entire system. It has progressed too far to be dismissed as a rumor or shelved as a speculative initiative. 1.4 The role of tiers in the redemption process. A key feature of the redemption rollout has been the tiered structure. Tiers define groups of participants, with different levels of access, restrictions, and responsibilities. Tier 3 refers to early groups, often institutional or high-level participants, who entered under non-disclosure agreements. Their role was primarily to test and stabilize the system. Liquidity began flowing at this level, proving that the process could move from theory to practice. Tier 4B refers to retail participants, ordinary individuals who hold IQD or VND and who have been awaiting the chance to redeem. This group is larger, more diverse, and requires a different kind of logistical management. By beginning with Tier 3, supervisors ensured that when Tier 4B activation begins, the system already has demonstrated stability. The phased rollout minimizes risk and prevents sudden overload. 1.5 Geographic distribution of redemption centers. The confirmation of approved banks also included the establishment of redemption centers in strategic metropolitan locations. In the United States, Wells Fargo has prepared centers in 27 major cities. J.P. Morgan Chase has equipped more than 40 branches with staff trained, specifically, in handling foreign currency authentication. Other banks have concentrated regionally. Bank of America has built its presence largely in the southeastern U.S. TD Bank has emphasized the East Coast. PNC has centered operations in the Great Lakes area. HSBC has bridged U.S. operations with international hubs, particularly on the West Coast. U.S. Bank has integrated redemption sites into newly designed digital frameworks. International coverage is equally important. Standard Chartered has established hubs in London, Singapore, and Dubai. Emirates NBD is overseeing redemptions in the Middle East, while ICBC in China is providing liquidity in alignment with domestic surveillance systems. BNP Paribas, Deutsche Bank, and the Royal Bank of Canada are providing coverage across Europe and North America. Smaller regional institutions also play vital roles. The Iraqi National Bank, for instance, handles redemptions connected to Iraq and Jordan. Other local players in South Asia and the Middle East ensure that participants in those regions can access the process without excessive travel or cross-border complexity. This global distribution demonstrates how the redemption system has been carefully engineered to handle participants across continents. 1.6 Compliance, security, and documentation. One of the most important requirements for redemption is compliance. Participants are not simply walking into banks with currency in hand. Strict documentation is required. Valid government identification proof of purchase of IQD or VND currency declaration forms for those seeking contract rates rather than market rates. Additional documentation is often necessary. Wealth plans, humanitarian project outlines, or detailed use of funds documents may be requested. These requirements are not arbitrary. They ensure that payouts align with regulatory oversight and that banks can justify the redemption terms to international supervisors. Security standards are also exceptionally strict. Redemption centers are fortified, transactions are monitored, and non-disclosure agreements may be required in certain cases. Notes must be presented in bundled form, authenticated by trained staff, and verified through advanced anti-counterfeit systems. Participants are repeatedly warned not to attempt redemption through unauthorized intermediaries. Access is controlled exclusively through official scheduling systems, often involving secure notifications, 800 numbers, or other verified communication channels. 1.7 Payment structures and redemption options. Participants should also understand the choices available to them during redemption. Payment can take the form of lump sum dispersals, structured payouts over time, or allocations into trusts and protective structures. Each option comes with its own risks and benefits. Lump sums provide immediate liquidity but require strong preparation to avoid mismanagement. Structured payouts provide stability, dispersing funds over years and reducing the risk of sudden losses or poor financial decisions. Trusts and protective structures allow for legal and financial safeguards, ensuring that wealth is preserved for long-term use. These structures are not optional whims of the banks. They reflect compliance with global regulations and an effort to prevent systemic disruptions that could arise if trillions in liquidity were released without safeguards. 1.8 Market rates versus contract rates. The redemption system distinguishes between two primary categories of rates. Market rates, which reflect live values based on supply and demand. Contract rates, which are prearranged and often significantly higher than current market levels. Access to contract rates typically requires additional documentation, oversight, and in some cases philanthropic or project-based commitments. For example, holders who present detailed humanitarian project plans may be eligible for these higher rates under the condition that funds are allocated to approved initiatives. This system balances fairness and oversight. Market rates ensure basic liquidity for all participants, while contract rates create a pathway for large-scale, purposeful investment aligned with broader economic goals. 1.9 The role of international supervisors. International oversight is crucial to the redemption framework. The U.S. Treasury, the IMF, and the BIS are all directly involved. Their role is to ensure that the process remains compliant, transparent, and aligned with global financial regulations. The banks themselves are not left to independently decide how redemptions occur. Instead, they are bound by strict supervisory protocols, audited regularly, and required to meet the highest possible security standards. This creates a safeguard for both the financial system and the individual participants. The confirmation of banks authorized to manage IQD and VND redemptions marks the beginning of a new phase in the process. For years, the topic was clouded by uncertainty, rumor, and conflicting reports. Now, participants have clarity. The safe banking network has established a foundation of trust. The global shift toward asset-backed systems has ensured that the redemption framework cannot easily be undone. Tier-based rollouts, compliance requirements, and international oversight all point to a carefully designed structure that prioritizes both security and fairness. As the process advances, participants in Tier 4B must prepare carefully, gathering documents, understanding payment structures, and respecting protocols. The confirmation of approved banks is not just another step forward. It is a definitive milestone signaling that the redemption system is no longer theoretical. It is active, supervised, and fully operational. Redemption logistics, participant responsibilities, and the path ahead. The confirmation of approved banks has established the groundwork for the redemption process. Yet for participants, especially those categorized under Tier 4B, the real concern is not only which banks are involved, but how the process will unfold in practice. The operational side of redemption includes scheduling appointments, meeting documentation requirements, ensuring compliance with security protocols, and choosing among different payment structures. This section provides a comprehensive exploration of those practical realities. It explains why participants cannot simply walk into a branch with currency, how notifications will be delivered, what timelines are expected, and what pitfalls must be avoided. It also addresses frequently asked questions that have circulated for years, clarifying misconceptions and replacing uncertainty with structured guidance. By delving into logistics and participant responsibilities, we highlight the importance of preparation and the dangers of neglecting protocols. In doing so, we make clear that redemption is not simply a financial event, but a highly controlled process governed by international standards. 2.1 Why redemption is controlled access. One of the most persistent myths surrounding currency redemption has been the assumption that participants could simply walk into a bank branch and exchange their notes whenever they wished. In reality, the redemption framework is intentionally designed as a controlled access system. The reasons for this structure are numerous. 1. Security. By restricting access, organizers can prevent fraudulent activity, counterfeit submissions, and unauthorized middlemen. 2. Compliance. International organizations, including the IMF and BIS, require precise tracking of transactions to ensure adherence to global financial regulations. 3. Logistics. The volume of participants in Tier 4B could overwhelm banks if left unmanaged. Controlled scheduling allows centers to operate efficiently. 4. Stability. Sudden surges of liquidity could destabilize economies. Structured redemption ensures gradual, stable integration into the financial system. This means participants must respect official scheduling mechanisms. Attempts to bypass them not only fail, but can jeopardize one's eligibility. 2.2. Scheduling and notification procedures. The most frequently asked question from retail holders has been, "How will I know when it is my turn?" The answer lies in the system of secure notifications. 800 numbers and verified channels. On the official redemption day, participants will receive notifications through verified sources. These may include secured websites, designated phone numbers, or encrypted communication channels. Appointment-based access. Once notified, participants must call or log in to schedule an appointment at their designated redemption center. Appointments will be set according to proximity, availability, and volume of participants in each region. No walk-ins allowed. Redemption centers are not ordinary bank branches. Without a scheduled appointment, access will be denied. This ensures security and prevents confusion. This process may feel restrictive, but it is designed to protect both participants and institutions. By funneling redemptions through controlled channels, the system reduces risks of fraud, leaks, or systemic disruption. 2.3. Documentation requirements. Participants must arrive at redemption centers fully prepared with the proper documentation. The requirements are clear and non-negotiable. 1. Government-issued identification, such as a driver's license, passport, or national ID card. This verifies identity and prevents impersonation. 2. Proof of purchase documentation showing where and when the IQD or VND was acquired. This may include receipts, transaction confirmations, or certificates from authorized dealers. 3. Currency declaration forms, forms acknowledging the amount of currency being redeemed and its source. These prevent money laundering and align with financial disclosure rules. 4. Additional plans for contract rates. Those pursuing higher-than-market rates may be required to present a wealth management plan, a humanitarian or infrastructure project, outline a use of funds statement, ensuring alignment with regulatory oversight. Failure to provide these documents may limit participants to market rates, or, in some cases, disqualify them entirely. 2.4. Security protocols. Redemption centers are not ordinary financial offices. They are purpose-built facilities, equipped with multiple layers of protection. Physical security, armed guards, surveillance systems, and controlled entry points safeguard both staff and participants. Authentication technology. Currency notes are scanned and verified using advanced anti-counterfeit technology. Non-disclosure agreements, NDA. Some participants may be required to sign NDAs, particularly when contract rates or special terms are involved. These agreements prevent sensitive details from leaking into public forums. Transaction monitoring. Each redemption is recorded, audited, and reported to international supervisors. Participants should expect the process to feel more formal and regulated than a traditional banking transaction. This formality underscores the seriousness of the framework. 2.5. Payment structures, lump sums versus structured payouts. Redemption is not simply about exchanging currency for cash. Participants will often face choices about how payouts are structured. 1. Lump sum payouts provide immediate liquidity, offer full access to funds at once, carry higher risks of mismanagement, theft, or poor financial planning. 2. Structured payouts disperse funds over months or years, provide stability and reduce the temptation of overspending. Allow banks and supervisors to track long-term compliance. 3. Trusts and protective structures designed for participants with significant amounts provide legal and financial safeguards, ensure generational wealth management, and compliance with tax rules. Participants must carefully weigh these options, ideally with the assistance of professional financial advisors. The choice is not only about personal convenience, but also about long-term sustainability. 2.6 Market versus contract rates. As discussed in Section 1, two categories of rates exist. Market rates based on live trading conditions, accessible to all participants. Contract rates, pre-negotiated and often significantly higher, available only under strict conditions. For contract rates, documentation is crucial. Humanitarian project outlines, philanthropic commitments, or detailed business plans may be required. The rationale is clear. Contract rates are tied to broader global objectives. By linking them to projects that benefit communities, the framework ensures that higher payouts support development rather than unchecked personal consumption. 2.7 Geographic distribution and regional hubs. In addition to U.S. centers, international hubs have been strategically established. North America major cities like New York, Houston, Atlanta, Los Angeles, Chicago, and Miami host facilities. Europe, London, Frankfurt, and Paris act as central nodes. Middle East, Dubai, and Istanbul serve as regional anchors. Asia, Singapore, Hong Kong, and Beijing have been positioned as hubs. These hubs are fortified with compliance systems and staffed with specialists in currency authentication. The global spread ensures accessibility and reduces pressure on any single region. 2.8 Timelines and redemption windows. Timelines have always been a subject of speculation, but recent reports suggest a more concrete structure. 1. Tier 3 transactions already underway, serving as proof of stability. 2. Tier 4B notifications, expected within 3-4 days after Tier 3 confirmations. 3. Primary redemption window, approximately 15 days, though adjustable depending on volume and logistics. 4. Completion phase, could extend several weeks, with structured payouts continuing beyond the initial window. Participants must understand that while the initial redemption window is relatively short, structured processes ensure no one is excluded due to logistical constraints. 2.9 Risks and warnings. The redemption process comes with clear warnings. Do not approach banks without an appointment. Walk-ins will not be accepted. Avoid unapproved middlemen. Unauthorized brokers or facilitators cannot provide legitimate access. Respect NDAs and confidentiality. Leaking contract rates or sensitive details can jeopardize personal eligibility. Beware of scams. Fraudulent offers, fake 800 numbers, or counterfeit receipts remain real threats. Security and compliance are not only institutional responsibilities, but also participant obligations. Carelessness or impatience can result in disqualification. 2.10 Frequently asked questions. 1. Can I walk into my local branch tomorrow to redeem? No. Redemption requires an official appointment through secure channels. 2. Are contract rates negotiable? Yes, but only with proper documentation such as humanitarian project plans. 3. Will I pay taxes on redemption? Tax implications vary by jurisdiction and payout structure. Professional advice is strongly recommended. 4. What happens if I lose my receipts? Without proof of purchase, participants may be limited to market rates. 5. Can redemptions collapse if banks withdraw? Number approved banks are under binding compliance agreements. 2.11 The path beyond redemption. Redemption is not the end of the process. In many ways, it is the beginning. Once participants complete their exchanges, they face critical decisions about wealth management, taxation, and compliance. Mismanagement of funds could create personal risks, while wise planning could establish generational security. Participants are urged to seek professional financial planning, tax advisory, services, legal structures for trusts, and estates, long-term philanthropic strategies. If pursuing contract rates, the system has been carefully built to encourage responsibility. Those who align with its expectations will find themselves well-positioned for long-term success. 2.12 Conclusion. The redemption framework is more than a financial transaction. It is a carefully designed, tightly regulated, and internationally supervised system that balances security, compliance, and accessibility. For Tier 4B participants, success depends on preparation. Securing documentation, respecting protocols, and making informed decisions about payout structures. The path ahead requires patience, responsibility, and discretion. The global rollout of redemption centers, secure notification systems, and structured payout options signals that the process has entered its final operational stage. No longer rumor or speculation, it is now unfolding in real time under the oversight of some of the world's most powerful financial institutions. For those who have waited years for this moment, the task is simple yet critical. Follow instructions, respect the rules, and prepare wisely for the opportunities ahead. Disclaimer: all content provided by IQD Global Intel is for educational and informational purposes only. We are not financial advisors and do not provide investment, trading, or banking advice. Viewers should always conduct their own research and consult with a licensed financial advisor before making any financial decisions.